Everyone says buying a house is the best investment you will ever make. Your parents said it, your grandparents said it, your real estate agent definitely said it. But what if they were all wrong? What if the math, the real math, tells a completely different story? I ran the actual numbers. I stress tested every assumption. And what I found shocked me. Welcome back to the channel. I am Knox, and on this channel, we break down real financial strategies so you can build real wealth, not just follow advice that sounds good at a dinner table. If you are new here, hit that like button right now and subscribe so you never miss a video that could change the way you think about money. We drop new content every single week, and trust me, you do not want to miss what is coming. Today we are settling one of the biggest financial debates of all time: house versus stocks. Who wins? Let us get into it. All right, let us start by setting the stage, because most people compare these two options completely wrong. When someone buys a house, they say things like, I bought it for $200,000 and sold it for $400,000. I doubled my money. And yes, on the surface, that sounds incredible. But we are not here for surface level math. We are here for the real math. So let us build a fair, honest comparison. We will look at the same person, the same starting money, the same time period, and see what actually happens when you put your money into a house versus putting it into stocks. Let us call our person Alex. Alex has $60,000 saved up. That is a 20% down payment on a $300,000 home. Alex is 30 years old. We are going to follow Alex for 30 years. The house scenario. Alex buys the home, $300,000, 20% down. That is $60,000 out of pocket. Alex takes on a $240,000 mortgage at a 7% interest rate over 30 years. Now here's the first thing most people ignore. The monthly mortgage payment on that loan, roughly $1,596 per month, just in principal and interest. Add property taxes, insurance, and maintenance, and we are easily looking at $2,200 to $2,500 per month every single month for 30 years. Over 30 years, Alex will pay back the original $240,000 in principal, plus nearly $340,000 in interest alone. That is a staggering number, and we have not even touched maintenance yet. Studies consistently show that homeowners spend between 1% and 3% of their home's value every single year on maintenance and repairs. On a $300,000 home, that is $3,000 to $9,000 per year. Let us use a conservative 2%. That is $6,000 a year or $180,000 over 30 years. Now, the good news. Home values do appreciate. Historically, U.S. home prices have grown at roughly 3 to 4% per year on average. At 4% annual appreciation, that $300,000 home becomes approximately $973,000 after 30 years. Incredible, right? But here is what the headline misses. Your net gain is not $973,000. You subtract your original purchase price. You subtract $340,000 in interest paid. You subtract $180,000 in maintenance. You subtract property taxes, which over 30 years could easily total another $130,000 or more. When you add it all up, the true net profit on that home, after all costs, comes out to somewhere between $250,000 and $320,000 in real spendable gains over 30 years. Still solid. But the story is not over. The stock market scenario. Now let us see what happens if Alex puts that same $60,000 into a low-cost index fund, something that simply tracks the S&P 500. The S&P 500 has historically returned an average of about 10% per year over long periods of time. Some years are up massively, some years are down, but over 30 years, 10% is the long-run historical average. If Alex invests $60,000 and never adds another penny, just lets it sit and compound at 10% annually for 30 years, here is what happens. $60,000 becomes $1 million, $47,000, over $1 million from a single $60,000 investment. That is the power of compound interest. But wait, there is more. In the house scenario, Alex is paying $2,200 to $2,500 a month in housing costs. If Alex instead rents, let us say for $1,500 a month, that frees up about $700 to $1,000 per month. Let us say Alex invests just $700 per month into that same index fund, on top of the initial $60,000. Over 30 years at 10% annual returns, those monthly contributions grow to an additional $1,411,000. Add that to the original investment, and Alex could be sitting on over $2,400,000 in the stock portfolio. That is before accounting for tax advantages like a Roth IRA or 401k, which would make those numbers even higher. But wait, is that a fair comparison? Now, I know what you are thinking. Knox, that is not a fair comparison because homeowners are building equity. They are not throwing money away on rent. And you are right to push back on that. So let us address it head on. Yes, every mortgage payment you make builds equity. By year 30, Alex owns a home worth nearly $1 million, free and clear. That is real, tangible wealth. And there is something deeply human about owning the place where you live. Security, stability, roots. But here is what the numbers reveal. The rate of wealth building in a diversified stock portfolio has historically been significantly higher than in real estate, especially when you factor in all the hidden costs of home ownership. Real estate also gives you leverage. You control a $300,000 asset with only $60,000 of your own money. If the home doubles in value, your return on your initial investment is actually massive in percentage terms. That leverage works in your favor in a rising market. But leverage is a double-edged sword. If home values drop, as they did in 2008, that same leverage amplifies your losses. Stock market investors lost money in 2008 too, but they did not get foreclosed on. They did not owe more than their investment was worth. What the math actually tells us. So here is the honest conclusion the numbers point to. In most realistic scenarios, a disciplined investor who rents and consistently invests in diversified index funds will accumulate more total wealth over a 30-year period than a homeowner, when all costs are properly accounted for. However, and this is critical, most people are not disciplined investors. Most people will not take that monthly difference and invest it. They will lifestyle inflate. They will spend it. A home mortgage is, for many people, a forced savings plan. It forces you to build equity whether you feel like it or not. There is also the psychological element of home ownership, the sense of pride and stability it brings, the ability to renovate, customize, and put down real roots in a community. These things have value that does not show up in a spreadsheet. And let us not forget the tax advantages of home ownership. Mortgage interest deductions, capital gains exclusions of up to $250,000 for single filers and $500,000 for married filers when you sell your primary residence. These can meaningfully shift the math in real estate's favor, depending on your situation. Location also changes everything. In high-growth metro areas, think Austin, Miami, New York, real estate has outperformed significantly over certain periods. In slower growth areas, stocks win by a landslide almost every time. The hybrid truth. Here is what the smartest investors actually do. They do not pick one or the other. They build both. They buy a home when the numbers make sense, when they plan to stay for at least 5 to 7 years, when the price-to-rent ratio is favorable, and when they have a solid emergency fund in place. And they also invest consistently in the stock market. Real wealth is built through diversification. Real estate gives you leverage, stability, and forced savings. The stock market gives you liquidity, growth, and compound returns. The best financial outcomes come from combining the strengths of both, not going all in on one. The people who do the worst are the ones who buy a home they cannot afford, have zero invested in the market, and then wonder why they feel financially stuck even after building equity for 20 years. The people who do the best are the ones who live within their means, invest consistently, and use home ownership as one tool in a bigger wealth-building strategy. So, who wins, house or stocks? The honest answer is, it depends. It depends on your market, your discipline, your time horizon, and your life goals. But if you are purely chasing maximum wealth accumulation and you have the discipline to invest consistently, the data strongly favors the stock market. If you want stability, forced savings, and the deep satisfaction of owning your home, real estate is a powerful tool that has built generational wealth for millions of families. The real lesson here is this. Do not let anyone, not your parents, not a real estate agent, not even me, tell you there is only one path to wealth. Run your numbers, understand your situation, and make the decision that fits your life. If this video helped you see the math differently, do me a favor. Hit that like button. It helps this channel grow more than you know. And if you are not subscribed yet, hit subscribe right now because we break down financial strategies like this every single week. I am Knox, go make smart moves, and I will see you in the next one.